Today on the show, we are going to be talking about these new APRA lending changes and work through potentially how it could impact you, your friend, how it might not impact you. It's certainly a big news kind of month for APRA. We'll talk about some career advice, which we might do first, and then do we renovate the home and buy an investment property or sell it and buy the dream property, all that stuff. But in the Facebook group, there was a post here, "Hi all, I'm looking for some advice." I got asked by a potential employer what my expected salary would be for a new role, keeping in mind I would be in training. I'm currently in the same/similar roles as a casual elsewhere and being paid the award rate. I'm expected to just be paid an award rate in the new position as well. What do I say when it comes up about expected salary? I'm very new to this industry and have very little experience. I never had a job where negotiating pay was an option. It has always just been the award rate. Rachelle Kroon and John Pidgeon from This Is Property. What are you saying to Anonymous here, Rach?
I would want to know what the guide is of what industry that you're getting paid. I mean, not just the award, but what are people in your industry that you're looking at going and getting paid? But then again, training's a really important thing as well, isn't it? If you can upskill.
Well, the fact that they've got I got asked by an potential employer what my expected salary was, they're half entertaining this anyway. So I think a lot of the time this person may be more experienced and competent than what they actually think. What are you saying to this?
Yeah, I think you're right, Rach. It's a combination of industry, what's the award versus the experience of the candidate and how niche it is as well. Like, can they be easily replaced if they don't accept the job or don't accept the pay? I don't know. Like, there's obviously a lot of variables to it, but yeah, it's something's worth what someone's prepared to pay.
I think as well, I would be saying to this person, like, if you do need some actual numbers, have a look at your award and just add 20 or 30% to it and see what they say.
Well,
because everyone in my business, we've got an award, the miscellaneous award. We're nowhere near the award.
So do you run the gauntlet and go above with the potential of the employer just saying, well, no, that's too high, next candidate? Or do they come back and say, well, we can't do that, but we can do X, which is already above Y?
What are you doing in that situation?
See, I have no idea what the award is in the industry that I'm hiring. I have a standard that I would pay people.
Yeah,
and
but
if
you're going more off the market than the award.
Yeah, but if somebody expects more, I want to know that, because I also don't want to, give somebody an offer that's below what they need in their life. So maybe that employer, maybe that's just part of their standard question. What is your expected salary?
The interesting part about all this, and I'm probably more on the employer side than I've been on the employee, but you look at it and say, well, what is someone worth to the business? But like you can't just say, well, I need $110,000 to live because I've got to upgrade my car. Like it
sounds like a you problem.
Yeah, that's right. So it's a bit of toing and froing generally, isn't it? But it's a good conversation to have, and it's obviously new for this person because it's just, well, I'm a teacher, this is what I get paid sort of thing. Yeah,
if I was in an interview and somebody asked me what my expected salary was, I would definitely answer that with a question. I would definitely say, I'd be really interested to know what the range is for this role before I answered that.
Yeah.
Good answer.
Yeah, so I don't know. I think my thing is roll the dice and just even do 20% above award, go, look, I'm looking at this, but understand budgets, whatnot. I don't know, just have a conversation. It's the best shot you've got is before your employment starts, I think.
The other part of it is we're also maybe presuming that she hasn't got a job, or he?
Well, no, they've got a current job, but I don't know. I've got asked by a potential employer, so they're obviously shopping.
Currently in the same similar role as a casual.
Yeah.
And if it's a full-time job, then that's a bonus.
Yeah.
if she wants, if they want it.
Yep. So
Anyway.
there you have it. This episode is brought to you by Sphere Home Loans. We're a pro mortgage broker here. If you are in the market for a new house, an old house, you want to cash out your equity and go to Prague on a holiday, probably don't do that. But anything related to home lending, we encourage all our listeners to go to Sphere Home Loans, who have a dedicated team who support listeners of our show. And it will become apparent the value of a mortgage broker when we talk about these APRA lending changes momentarily. So you can reach out to Sphere Home Loans. There's a link in the show notes, or you can jump on Google and Google them, or go to the website spherehomeloans.com.au. John Pidgeon and Rachelle Kroon, you ready to do a show?
Let's do it.
All right. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11, or if you're just getting started. Let's get into it. Thank you so much for being here today. Okay, so the Australian Prudential Regulatory Authority, they basically govern the banks, super funds, and where ASIC govern companies and the ATO govern self-managed super funds. So they're just one of the cogs in the regulatory wheel in Australia. The Central Bank, Reserve Bank of Australia, they do monetary policy. So all these things kind of work together. But it had been some time since APRA have stepped up and put their finger on a scale and made an announcement. And I did a reel on this, or a post a couple of weeks ago when it first came out. Rach, what are they effectively doing, and what did they announce?
Yeah, so APRA have come out and said that from February 2026, they are going to put a rule with the banks to say you can only take a certain percentage of clients that have a DTI, which is a debt to income ratio of over 6%. So that really means people that are multiple investors and are borrowing a lot in comparison to their income. The banks can only take a certain amount of that. Now, I would say that this is a warning shot. This actual policy itself isn't going to affect a lot of people, but it might be the warning shot to say to the banks, we've definitely got our eyes on your investment lending, and you might want to do something about that before we do.
So I think it's, in the post that I did on Instagram, is it fair to say that, pedestrian people out there, or regular owner-occupiers, so they just want to buy a house, get a mortgage, or rent and get an investment property, do you think out there in the wild that it will impact them, or more the multiple property investor types? Absolutely
not anyone with a single property.
Right.
There is not a single person that has a single loan, whether it be for owner-occupied or investment purposes, that we've seen with a DTI of over 6. This is for people with multiple properties.
So one of the things that I think it's worth to say, in the background, the different banks or lenders, they always had a look at this unofficially anyway with their internal policy. Is that correct?
That's right. So in a servicing calculator for the bank, how it works now is whether it services or not, and there's a 3% buffer on top of it. And in the background, there's a figure called DTI, which is debt to income ratio. Now, in my career, there's been times where DTIs, come up and down, and some banks, look at it more than others. But some banks have a background DTI where it says, we actually won't take it now if it's got a maximum of 8 or a maximum of 10 in some of the more investment space banks.
Yeah. And John, with your dealings of being a capitalist pig property investor, I labelled the Instagram thing that attention capitalist piggies.
Did you?
I did.
Oink.
Oink, oink. So for me with my lending, I think last time when we were doing stuff, the broker mentioned to me the words DTI.
Yeah.
So the lender that, they were looking at, it had obviously maybe was going near that.
Yeah.
Have you had any, dealings in the wild? Or am I just leveraged up like a dirty pig?
Yeah, probably that. But I think it doesn't get used probably on the ground too much. It's just layman's terms, we can't service. Like you can't borrow enough money. That's really the end result, isn't it? And like 6%, the debt to income ratio, like when you look at it, it's $2 million of debt versus 120K of income, right? So you're right, Rach. There's a lot of people not affected by that because they're buying their owner-occupier, might have $1 million mortgage, and that's still below that 6% if their income's around $100,000. So it's the investors that they're trying to target and attack in this change. But you mentioned 20% as the figure.
That's right. So they can still have investors with a DTI of over 6. They just can only have a certain percentage. Now, I reached out to a major bank yesterday and said, "What's your percentage right now?" And it's well below that. So they don't even consider that they're going to have to do anything right now.
If you're talking to a lender and they're like, "We're way below the 20%," I don't think this is actually going to change much on the ground at all because. No. The only thing I reckon it will change is if somebody went to Sphere Home Loans and like, look, we want to do this and do that, you will hopefully be able to ask one of the banks or lenders what percentage is the lending pool at? Because if a bank can only have 20% of its book over 6 times, their current bank might not be able to do the deal and they might have to move to another one.
But I think what we need to look at is this as the step one to say this is APRA saying investors are in our sights, and I think that the banks have basically been given a warning by this move to say you need to tighten up your investment lending, and I don't believe this will be the last we see.
Yeah.
On that, I think for investors, we're talking really, and we spoke about it on This Is Property, so swing over to that if you want a bit of a chat about that as well.
Which is there. I think that episode's going up tomorrow if people are listening to this on the day it drops, because remember, this show always comes first, John. Don't you forget that.
Wow.
It's just the timing actually. But
6, 7.
Yeah, whatever.
When you look at investor mindsets, this is affecting someone with 2 or 3 or 4 properties, right? And it's a really small percentage of the country. But also their mindset is, I'll find a way. So it's like thinking left field, all right, I go to a second-tier lender that's not under the APRA regulations. Like there's a way around it. So you're right. I don't think it affects too much, but what's coming next is anyone's guess. But yeah, as we spoke about on the show, I think it's not the investor's issue here. It's the government's and the supply lack of.
But particularly for those with multiple properties, they may be painted into a corner real soon because. Number one, if someone wanted to buy another property, we know that CBA and Macquarie aren't doing entity lending anymore. So that's,
CBA is still doing it for their existing customers.
But for new business.
Yep.
So, and then secondly, one thing that could potentially be a trap for a very small portion of people is if they're debted up to the hill. So in the case study that I did on Instagram, the total debt was 1.62. Thanks to Rachel's team for putting this case study together. 200K of household income, no help debt. Their current DTI is 6.18. Now, if they were with a lender and those interest-only loans were going to roll off next June, there's a very, very, very high chance that they can't use the lender that they're currently with to re-roll over that debt if that current lender is already at 20% on their book. Is that a fair statement?
Yeah, and if let's look back to 2017, which is the last time APRA had investors in their sights, and it really didn't slow the market. John and I were just talking about this. It really didn't slow the market, but what it did do was there were a lot of investors that came to do things like extend interest-only terms or get cash out, and they weren't able to do it. Or even you've got a few investment properties, but you're upsizing your owner-occupied home and you can't do it. So I think people do need to review their lending and check that everything's in order before these changes come in February as a precaution.
For those sitting there on the fence saying, well, I'll wait till these changes come in February and then there'll be a whole heap of stock on the market, I think you'll be unpleasantly surprised that there won't be because of just this condition in the country right now where the supply is so low. 2017 in a lot of cases was the opposite. There was a oversupply in a lot of markets at that stage. So
yeah, I'm looking at a lot of noise though of people who have messaged us. They've seen things on the news and then they've messaged us, and the majority of them are first home buyers saying, is this going to impact me? So I guess my words for anyone who's looking to get into the market, it's not going to affect you. This is not this DTI thing is APRA targeting multiple investors. If anything, it might help you next year.
Yeah. So I think, yeah, it's a bit of a cold shower, but it is interesting just that APRA have actually stepped up and, maybe what do they call it, like all bark and no bite type thing. Like I don't know if this policy will change much on the ground. But, particularly if you are an investor with multiple properties, might be a pinch. Any other things that people need to know about that or any other lending changes that you've seen out there in the wild before the end of the year?
I would just say if I was a multiple investor with multiple properties and had 1 year left on all my interest-only terms, I'd probably consider restructuring that before February.
Right. But that could be very hard, like at December, the 9th time of
you've got plenty
release.
of time.
All right.
and the other part to that is be prepared to pay P&I eventually on your properties. Like back in the late 90s, early 2000s, it was just a given that it was just interest-only periods forever.
Never paying P&I on my
You didn't even question it. It wasn't even a conversation, whereas obviously fast forward to now, it's you try to lock in 5 years if you can and then potentially another 5 years either with the same lender or another lender. But then at that stage, you'd want to be starting to pay something down, I would have thought.
Well,
you're looking at me funny.
I'm like, why?
Rachel's just in it for the capital growth.
I'm just
baby.
in for the capital growth. I'm never paying principal.
Investor.
I'm one of those people. Sorry.
You piggies, both of you. Well, I kind of am as well, I guess. I think a few people got offended by that comment, capitalist piggies, but it's a bit tongue-in-cheek and also...
And you can be a capitalist and want to invest, but also want the legislation to benefit first home buyers. I feel like APRA should make this move. I feel like investors should be slowed a little bit. I feel like the first home buyers didn't benefit from that 5% scheme as much as they should have been able to because investors beat them to the race. And I would, even as an investor, I want to see that change.
I'm putting it out there. I think it affects the homeowner in Sydney more than it does the investor.
Yeah, okay.
You got to spend over $2 million to buy anything half decent in Sydney. They may not have the income.
Yeah.
If that particular lender, they just need to be strategic with their thinking on that because, they could get caught up in it.
I think there needs to be some type of, I know it's hard, but I think New Zealand did it with their capital cities within a circle, kilometre. If you wanted to buy an investment property within that circle, it was a legislated higher interest rate. Just something like that.
Really?
Yeah.
Well, they do their postcodes, banks anyway, so maybe
but they don't
that
mandate.
comes into play.
They wouldn't mandate a higher interest rate with
Not
a
a higher
postcode.
interest
But
rate,
if,
but
like,
they'll
if you drew
restrict the lending.
Yeah, but if you did a circle around Sydney, 25 or 30 Ks, and you're like, if you want to be an investor in this circle, there's an extra 1.5%. Like, I think we need radical policy like that.
But in that example, no one can afford to invest there because the yields are so crappy.
Yeah, but hopefully, well, people still do. That's the thing. Like how many? Remember when my friend was buying those an apartment, and I was, she ended up buying one, an older one, in the east, and it was actually a 1-bedroom and perfect for her. Like, absolutely perfect. But the amount of strata reports that we had looked at were around Ryde and these city buildings. You could just see that the whole building was investors because no one was paying their body corporate, no one cared, and they were selling them for less than what they paid for it. Yeah. And I still think when you say, people won't but people still do buy investment properties when they're not educated through the likes of John Pidgeon et al.
There you go.
So We'll be back to continue this chat right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
Okay, might be a shorter episode today, just because I was interrupted as we were recording at the start by the company that I'm litigating for being grubs. So we're on a time schedule. But a couple of things, just some housekeeping. In the Facebook group now, you can actually add an anonymous nickname to your profile. So while anonymous posting is turned off, you can now put an anonymous nickname on your user profile and still comment. Now, I don't like that because it might turn the thing into a cesspool, because a lot of Facebook groups that I'm part of that have just all anonymous posts, it's a bit of a cesspool. So I would really encourage everyone to not use the nicknames unless you're posting something that's very personal and mission critical. And I will also tell everyone I can actually see whose name it is behind the nickname as the admin. So I will, if it gets bad, because I've sort of worked out how I'm going to moderate this so it doesn't turn into a cesspool, I'll put this was posted by John Pidgeon.
So turn your Foxy Girl 21 off and post as Rachel, all right?
At least I know he'll see it if I'm.
So just a bit of housekeeping. And if it does turn into a cesspool, well, I'll just close the group because what do? Go to Reddit if you want a cesspool, please. And then if you haven't been listening for a while, the Quick Start Guide to Investing, it did win the Australian Book Awards. Personal Finance Book of the Year 2025 and Overall Book of the Year 2025. So really proud. We're about to get them reprinted with the award-winning badges on the front. And they're a good Christmas present for people in your life. But it's an award-winning book as a panel of judges put their rigorous crap through it.
It's the real deal.
And then, next year, Rach and I are releasing the Quick Start Guide to Your First Property. So there we have it.
There we go.
It's a big book to follow.
It is.
Double award winner.
Stamp.
So we probably should get the Oracle of Toowoomba Bay to have a read of that as well at some point. John, Pidgeon.
Yes.
The book? Oh, can't wait to read it.
No, but like the draft.
Oh, yes.
Yes. Look, happy to.
Do you guys get me when I said the Oracle of Toowoomba Bay? So Warren Buffett's called the Oracle of Omaha.
Yeah.
I
sort of looked
very
over.
I was
niche.
a little blank.
Yeah, I know. I
Did
know.
you see it?
I ignored it.
Yeah, it was niche. Okay, in the Facebook group, if someone in our community is doing it tough financially, what tips, resources, or words of support would you share? Johnson.
Rahadian. Contact financial counsellor, in brackets I didn't realise they exist and free of charge until I listened to the last episode.
True, there was an episode a couple of weeks ago on that.
Blessy says, getting a second job is the best decision I made. I'm in a better position financially.
Yeah, that's a good one.
Yeah, and then Leslie said, I second getting a second job. I don't know. I just think if you're in a bad position financially and it's caused due to some external factor that impacted your mental health and everything was spiraling out, might not be an option.
Yeah.
But might be as well.
I remember
Debbie
it's
Downer over
surplus
here.
and all salary.
I just know what it's...
I remember in my 20s I had a second job that just propelled to the next level. I agree. I'm with that. If you're in the space to do it.
All these online people now who are like probably well under 30 doing content online, and they're doing like a sabbatical.
Oh.
It's called a holiday.
Yeah.
And I'll do the sabbatical and work on my side hustles. Like, no, you just got heaps of cash and you stopped your job. And
You're lazy.
well, it's like it's not sabbatical. Like you're literally just having a long break.
Yeah.
And also you've worked for 20 minutes, so there's that.
Michael, there is always a way forward no matter how far deep you are in the red. Don't be ashamed to reach out to services like Vinnie's. Sometimes they have eligibility, etc., but it's a good start. If people are at risk of homelessness, it's easier to keep people in a home while they are still there. Reach out earlier rather than later. Contact a financial counsellor.
Jay said, I'm jumping in because I don't want to read the next long one. It is...
Right.
It is... Jay said, it is simply a maths problem. You can either increase income or cut expenses. They are the only two outcomes that will move the needle. I think there's another outcome. Keep expenses the same and decrease your savings. If you got surplus that you're saving. What does Heather have to say?
Heather says a lot.
You don't have to, you can paraphrase.
Heather says, here's the start. Being in financial hardship is extremely stressful and can feel helpless. To make it bearable, the first thing you need to do is get the support system around you. The bigger the support system, the better. Contact at least 2 trusted family members and let them know what's going on. If your financial distress is caused by debt, contact the National Debt Helpline and then the details are there. Contact one trusted friend and let them know what is going on. Contact a good food parcel and secure ongoing weekly supply of food. Organisations such as Lighthouse and neighbourhood centres have food parcels for as little as $30 a week. Contact all of your utility providers and request bill smooth payment plans or hardship assistance. Consider whether this is a one-off issue or whether the hardship is ongoing.
Yeah. Or post in the Facebook group, hey, got a bit of a pickle. Anyone got any suggestions or words of encouragement?
Yeah.
You might want to do that. You might want to use the nickname and do it.
Foxy Girl 21.
100%. I just don't think people sometimes there's not a rule book of how to manage your budget, and I've seen people who have really strong incomes that still hit financial hardship.
Totally.
Because it's all about surplus, not salary, and it's not about what you earn as much as it is about what you do with what you earn. I just think a lot of people get in trouble without knowing what to do.
I think I'm crap with money. Like those who can't do teach.
It's not what you turn over, it's what's left over. I'm not that great at it, to be honest.
Is anyone? Not Rach is.
No, I was better when I've lived on a very small budget and done very well on a small budget, but I definitely got lifestyle creep when that income increased.
Yeah.
Where there's a lot of people I know that haven't had that lifestyle creep that are doing a lot more with their money.
Yeah, I'll never spend beyond my means, but at the same time, I'm not anal enough to look at what comes in and what goes out.
Yeah, and I think that's maybe, maybe I'm a lot harder on myself than what's the facts because, like, I don't do consumer debt. I have a system, the Glen James spending plan, and it probably is, if I wanted to save a lot more, I probably could, but I don't because I live and enjoy. But it's, I just think my system's pretty loose and, agile, but I'm going forward each year. But I think the thing is, it's like, can you go forward more? I'm like, I probably could, but I don't care enough.
Yeah. No, I hear that.
But I think there are a lot of people struggling at the moment. I think the cost of living has impacted a lot of people. Yeah. And I think there are people that it's not just I'm not saving money. There are people really, really struggling and people on double incomes that are really, really struggling. Yeah. And I think knowing your budget and understanding it is more important than ever.
Yeah. And I think the other thing that we're maybe not seeing a lot of just yet, unemployment is on the rise. There's a lot of people losing their job right now.
About that, you're fired, John.
It's not a good stat.
We will announce John's contract. It's going to be renewed for another 5 years. I think we agreed, didn't we?
Did we?
I've got a draft email.
Is there a contract?
Yeah, I've got to get you to sign one.
I have never been given a contract.
Well, you're on probation.
First, when we started, we didn't even have a handshake.
No.
Now, it's very formal.
It is. So John's going to be extended through to 2030.
It gets expired, and 3 years later we then, actually that expired 3 years ago, so we better.
No, it expires at the end of December this year.
Oh, does it?
Yeah.
Okay.
Oh, well, I'm just jealous that you get some sort of contract.
I've got to get you one, Rach. So we've just got to work on a couple of our little commercial things, and then, contract renewal is a nice place to press reset, isn't it, John? All right. Thank you for everyone being involved in the Facebook group. Okay. Katie. Hi, everyone. I had the idea to start an investing account for each of my teenage daughters, 19 and 15, for Christmas this year. I was thinking that I could start them off with $400 each and then set an automatic payment of $20 per week into it moving forward. I was hoping that the 19-year-old would match me with the payment, but I guess we shall see how that unfolds. Has anyone done anything like this at all? Any advice, choice of platform? I think the reason I wanted to just bring this up, and then I'll throw to you guys, the 19-year-old, they're over 18, they're an adult, you'd get an investment account in their name, strapped to their tax file number, done. It gets annoying for investing for kids, and I'll put a link in the show notes to our blog, 6 Ways to Invest for Kids. But I'm almost thinking Katie sets up an account just in her name for the 15-year-old and declares the income and all that. And then when the 15-year-old comes online, if they're really interested in money, maybe they can start an account in their own name with their own tax file number. And then at some point, the parcel, if we sell down and reinvest into the other name, because a lot of people are going to be like, well, you can set it up as trustee for a minor and that. A lot of people aren't doing the tax year on year the correct way. So do you both have any comments of that or on that?
Yeah, well, I suppose I've spoken about mine over the journey and what we've done for our three. My 16-year-old sent me a photo of a Toyota Hilux during the week with a O&O of 15K.
Oh, wow. Are you like, where are you getting that money
All
from,
right,
son?
so how are we going here? So for those that are new to the party, we've done the 80-20. When he started working, we've kept 80 of it, he's kept the 20, and we've put that into a separate account. As he's got older, it's been his own account, and I like that. We've done that for our 3 kids because they can see it. They can't have access to it, but they can actually see that it's in their name. They need a signatory to use the money, etc. So I think that gives them some sort of purpose as opposed to it being in my name, for example. But I think, Katie, the main thing is you've got something going on. It's a system, it's education, it's knowledge, it's engagement from them. What they do with it at the end of the day is ultimately up to them. You can only guide them, but you've got to let them, to some extent, be in the driver's seat as they get older. So,
because this thing, I think it is more a question about the 15-year-old than the 19.
So the 19's a no-brainer. Like, they've got to stand on their own 2 feet. They're working, but the 15, definitely. You could co-contribute, and that's a great idea, and we've definitely done that. It really depends on your own situation, isn't it? How much can you co-contribute, but just showing them that you're in their corner and you're educating them, more importantly, I think is the key.
And the most important thing is the conversation.
Yeah.
At least you're having the conversations about money, whether it's $5 that you're putting away or $50 a week. You're showing them that saving's important and investing's important.
Did you put money in separate accounts for your little kids?
I did. So my eldest did his own. He's a saver.
Yeah.
So as soon as he started working, he started saving himself, and I kept an eye on that. So I wasn't really involved. But my youngest, who is not working yet, and I already know that he will be a spender by nature, I will probably do what John – I'm probably going to take your advice and do the – a split where it's I've probably got more control over it because he would never do it willingly.
The good thing about that, and every kid's personality is different, of course, but they've seen their older sibling have that done to them. I shouldn't say it's like a death sentence, but they, as soon as they started working, that became the norm for them because they'd seen it in the household. So it sets a good standard for the siblings below them. But you're right, the spenders and savers and everyone's different.
I'm maybe even thinking for the 15-year-old, because the more I ever talk about it and research all the options, the less I'm excited about doing investment accounts in kids' names or as trustee for kids. And have a look at the blog, and there's 2 links to the 2 podcast episodes we did a deep dive on. The more I'm thinking is maybe it's just a bank account for the 15-year-old in their name, so there's a bit of ownership, and then we work on the habits and the intent and the mindset. And then when the 15-year-old, usually what I've noticed with kids, they're not all carbon copies. That 18-year-old who's now 15, when they come online, they may value a life experience of Europe or whatever, and that money could be used for then. Or it's like, no, we want to keep saving and investing. Then we commit that cash to an investment account in their own name. I'll take that as comments as a yay or nay, but it's a yay. And then any choice of platform. The only thing I would say is a custodial platform that has an omnibus HIN, not a traditional broker. So we're talking Superhero, BetaShares Direct, Sharesies, the Vanguard investment platform, because you just want easy consolidated tax reporting. In terms of investment options, you just want it really simple. I'm talking portfolio in a box, even if it's VAS, Australian shares only, even if it's DHHF, even if it's VDHG. Let's keep this really simple. I saw a question, actually in this comment, someone answers like, just Google ChatGPT and it'll do a portfolio of 5 ETFs. Like, these kids got no idea what the hell you're talking about, and they don't need to. So let's just do one investment option, straightforward. Even for the lesson, do one individual share. It doesn't really matter. Oh, actually, don't do that. But I think a blended ETF. All right, you two. What's Ranger25 saying here? Because you wanted to steal this for the property show, but we'll do it here.
I will give more an elaborate answer in that.
Yeah, that's right. Well, give us the cliff notes.
So what would you do? We will be getting our accountant's advice. Young married couple with plans to have kids in the next 5 years. We own a PPOR, bank valued at $810,000. We've got a mortgage of $325,000. We had an original of $500,000 in 2020. Currently undertaking renovations to make the house sellable or fit to rent, roughly $40,000 worth. Approximate combined income of $170,000 gross. If you were us, would you sell and use the money to buy the next family home, or leverage equity in the existing mortgage as a deposit for the next house and keep this as an investment? What would you do, John?
Well, Ranger 25, we're not you. And I think that's the first part of this is everyone's situation is different, everyone's risk profile is different, everyone's age is different, what you want in the next 10 years is different, etc. And I don't want to be vicious in my reply there. But I think some things to think about would be, if we're going to buy our, let's call it dream home, next home, if we're using equity from this existing property, we're loaning at 105% of the purchase price because we're using the bank's money for everything, stamp duty included. So we've got to understand that that's all bad debt, no income producing, and we've got to understand that the mortgage repayments are going to be higher than if we sold this property and put a large chunk of cash down and had a more of a manageable mortgage going forward. That's a sensible option, isn't it? I think. However, you lose an asset by doing that, and probably that's what they're thinking. So there's no right or wrong answer here, but it does come back to cash flow. If you're going to spend $40 on the reno, we need to be getting a rental appraisal to see what's going to rent out for, along with the new mortgage repayments when we go and upsize or upgrade the family home. So what do we want in 10 years? Do we want to spend the next 10 years paying down a higher mortgage because we haven't sold the property and we're using equity? Do we want holidays? Do we want lifestyle? It's really understanding the cash flow situation and what's going to change throughout that period. Like a lot of people would say, right, stress-free, I just want to live a manageable mortgage and get a holiday and have a nice lifestyle. The good thing about this is you've got choice.
Yeah.
If you can borrow that amount of money, you can have yourself 2 assets, fantastic. And if you decide after 12 months that things are a bit tight, then you can always sell that property if you wanted to.
Yeah, I would say the first thing that Ranger 25 should do is, yes, get that accountant's advice, but the next thing is you need to understand how it's going to look both ways. Whether you keep this house and buy a house to live in, or whether you sell and buy a house to live in and potentially you can still pivot and invest later, you need to see what the numbers look like. And I would see this very similar situation, and I would say 99 times out of 100, when somebody sees the figures, it would be very rare that they would leave $500,000 locked up in a property that's going to be an investment when they see that 500, what that could do for their own home. Because why would you want $1 million? Why would you want $1 million home loan when you can have a $500,000 home loan?
Yeah.
To me, I think it's a no-brainer. With that much equity in this house that was first a stepping stone, and the way that it's worded, I think the equity has come from growth, not from building up an offset account. I think it is a no-brainer. What do we want as our house to live in? Sell the bastard, put the cash in there, get settled there. You can always borrow against that to invest somewhere else.
Yeah, and usually, so I see this all the time, and you know in your head what they're going to do, but you want someone to understand for them why. Yeah. So I think once you see the numbers in front of you of what your mortgage repayments will be both ways and how it would look if you sold that property, bought again, and then maybe invested later, you'll naturally follow the numbers to go, oh, that doesn't actually make sense.
So your team can give a couple of scenarios on this?
Yeah, well, they can go back to whoever their mortgage broker is, will give them the numbers, and their accountant will say, this is how it's going to look, and this is how much tax you're going to pay on that rent.
You don't even go to the accountant, I don't think. The mortgage broker can just detail, this is the debt that's going to be tax deductible, this is the debt that isn't. I think it's a no-brainer. And sometimes when we do posts in the group, Ranger 25, you're likely just asking permission to sell the house. You've got our permission.
Yep.
I'm not totally sold on that.
Yeah, okay.
Because the 800...
Call John for a clarity call.
No, but if you look at it and say, well, we've got to see what type of asset this is. And if you've gone on the assessment that there has been large capital growth in a period of time, what if this 800K property is worth 1.6 in 10 years' time?
But you could sell it, you could buy your own home with $500,000 less mortgage, and you could go and buy an investment for exactly the same amount, and you could still have the two of the same assets.
Buy an investment
but have
in
a
different
tax-effective
location.
setup when you do it.
I get that, but the yield's going to be different, potentially different location, more stamp duty. So it's not a sold deal for me.
Well, I would rather spend $400. I'd rather spend $400 with John for an hour than the accountant for an hour, because there's just so much in here that's beyond the scope of an accountant in terms of asset selection.
I'd love to see their incomes,
to
be honest, to see what's happening in their life.
Approximate combined annual income, 170.
With 170 gross income, let me tell you what you're not doing. You're not having $1 million mortgage while keeping a $300,000 investment loan.
No. What are we spending on our upgrader?
Well, they're going to...
If you're upgrading from 800...
They're spending approximately $40K of renovations.
Yeah, but I mean, if we're buying this next family home, we don't know.
Let's assume $1 million.
Yeah, let's assume. Yeah, it's a big undertaking, isn't it?
Yeah.
All right.
So, I don't know. I just think... and they don't have kids yet. So, I don't know. Do you renovate it, go rent in the suburb that you want to buy for a couple of years and work out what you want? Press reset.
I think people get it wrong. I think people go onto realestate.com and look at properties and houses before they do the numbers. I think you've got to start with your budget and the numbers first, and that might be because I'm a money person, but I think if you don't see the numbers and how it's going to look, how can you jump on and look at properties or consider selling? You've got to look at what those figures are going to look like if you do this numbers-wise.
Yeah, no, definitely. But I think the thing that rings in the back of my melon is if you decide to hold on to it and you can manage it or not manage it, either way, you can always sell it in 12 months, 2 years, 3 years' time. Once you're sold, you can't unsell.
That is absolutely true.
you are basically Gandhi. But yeah, I'd rather spend the money with John than an accountant. So just Google John Pidgeon Clarity Call Rang Dog 25.
I thought you were joking. You said Frank at 20.
No, that's the name, the nickname. I'm going to see. I can see what your nickname's going to be. I can hover over Ranger 25 and see their name. So that's what I mean. If you do dumb stuff in the group, it's like, what's the best investment platform? And you use a nickname, I'm going to put under it, this was done by, Michelle W or something like that, or John P. or
and on it.
Yeah, because I don't want it to be a cesspool. All right, we've got to go. If you found this episode useful, that's a wild thing to do. But we thank you for having a watch today on YouTube. If you are still watching on YouTube, hey, give us that little subscribe and like and all the stuff. Send it to a friend. Send it to a family member. And we really appreciate you watching today, everyone. So we'll see you soon. Bye.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.